Hey guys, welcome back to the Ipda YouTube channel. And in today's video, we're going to go over the market maker models. All right, so as a quick preface, the market is moving from stops to inefficiencies. And this movement from stops to inefficiencies is what creates the phenomenon known as the market maker models. And there's two types of market maker models, the market maker buy model, or the MMBM, and the market maker sell model, or the MMSM. And the main aspects to the market maker models are the original consolidation, the smart money reversal, the redistribution and reaccumulation levels, and the low risk buys and the low risk sells. And the market maker model is a very high probable stage to take trades from if you understand what the draw on liquidity is. And the market maker model is nothing more than a more detailed way of understanding what you already see in price action. All right, so that last part is more so about understanding the delivery as opposed to just seeing the market maker model from a pattern-based perspective. And that's the level that I want to try to get you guys at by the end of the video. All right, so let's go ahead and move on to the next slide. All right, so this slide is mainly geared towards the beginners, but when I explain all these points, even the more advanced guys can take something away from this. But to start it off, I have the market maker models form within defined ranges, and the market maker buy model is price going lower to then go higher, and the market maker sell model is price going higher to then come lower. And then I have that the market maker models don't have to complete, and in a bullish market environment, the market maker buy models will complete, and the market maker sell models, they won't tend to complete. And finally, in a bearish market environment, market maker sell models will complete, and market maker buy models tend to not complete. Right, so let me explain exactly what I mean when I say all of this. So let's look at these 2 points right here. So initially, I say that the market maker buy model is price going lower to then go higher. So price is coming lower, and then something happens that causes price to then change over and go higher. So price is offering sell side delivery here, and then it's offering buy side delivery here. So the reason that it changes over is because it changes its state of delivery. And if you guys are familiar with our other videos, we talk about how changes in the state of delivery only happen at PD arrays. So that means that when price is coming lower, it's just seeking a bullish PD array. So bullish PD array. And then once it satisfies that bullish PD array, it'll then turn around and then start going higher. And then similarly, in a market maker sell model, that's just price going higher to then come lower. So price is offering buy side delivery, and then something happens to cause it to then, start to offer sell side delivery. And we understand that when price is going up, it meets something that causes it to change its state of delivery. And we understand that that something is a PD array. So during a market maker sell model, price is going up to meet a premium array or a bearish PD array. And then once it meets that PD array, price will then change its state of delivery, and then it'll start coming lower. All right, so now that we got these 2 points out of the way, let's go over this one right here. So what do I mean when I say that market maker models don't have to complete? Well, if you guys have seen that picture of what a market maker model is from ICT, you'll understand that a market maker buy model, a market maker sell model looks something like this, and then a market maker buy model looks something like this. Now, these are examples of completed market maker models. So price has that original consolidation here, price then goes higher, and then it comes lower, and then it takes out that original consolidation during a sell model. And then during a buy model, price will have its original consolidation up here, price will come lower, and then it'll go higher and take out that original consolidation. Now, one alternative that price could do is price could let's say for a sell model, price could go higher, and then it could then just come lower like this. And this would be a market maker sell model as well, because think about it, based off of our loose definition right here, price has gone higher and then it has come lower, right? So we'll talk about the significance of market maker models that don't complete in just a little bit. So just bear with me for a second. And then similarly, during a market maker buy model, price will come lower and then it will turn around and then go higher. And then notice how in this example, price doesn't complete either, right? So this would be also classified as a market maker buy model, but it doesn't have to complete. All right, so we've covered this. Now let's go on to what I mean when I say these two things right here. So right here, I say that a bullish market, or in a bullish market, the market maker buy models will complete and the market maker sell models, they won't tend to complete. So what do I mean by this? So here is our bullish market, right? So in a bullish trending market, we understand that price is going from stops to inefficiency, from inefficiency back to stops, and then from stops back to inefficiency, and so on and so forth. So price is just taking out stops, and we understand that price should want to, most likely continue this order flow. So what happens is we'll have this inefficiency within the range, and then price will then come lower towards that inefficiency. It'll meet that inefficiency or the PD array within the range that it's looking for. And then from there, it'll reverse and then go higher. This right here is a completed market maker model, right? So this is a completed market maker buy model. And we understand that market maker buy models that complete will most likely take place in bullish market environments. And that's also what I mean when I say that market maker models form within defined ranges, right? So think about it. Right here, let's make this a yellow color. We have this range low and we have this range high. And then within that forms this market maker buy model. So that's what I mean when I say market maker models form within defined ranges. And within this diagram that I just drew, there's also a market maker sell model that doesn't complete. So what is a market maker sell model? Well, I gave you that loose definition right here, which is that a market maker sell model is price going higher to then come lower. So where does price do that? Price comes higher and then it comes lower. But why doesn't it complete? Well, because we're in a bullish market, right? So the market maker sell models, they won't tend to complete, but the market maker buy models will in a bullish environment. Now let's take a look at a bearish environment. So we understand that in a bearish trending environment, price is going sell stops back to inefficiencies. So right here, we've just taken out stops, and then the inefficiency is within the range. So what price will do is it will go back up towards that inefficiency within that range or that PD array. And then based off of that, or based off of price meeting that array, price will then go on to the sell side of the curve, and then it will continue its order flow like so. Right? So that's what happens in a bearish market environment. And then, as I mentioned, this market maker model forms within this defined range from the high down to the low. All right. So just to quickly add that in. And then, so this is a market maker sell model in a bearish environment. So we anticipate for it to complete. Now let's identify where the market maker buy model is within this same example. So what is a market maker buy model? Well, we loosely define that as price going lower to then go higher. So right here, price has come lower, and then it's changed its state of delivery and then gone higher towards that PD array. But why doesn't it complete? Because we're in a bearish environment and we don't anticipate for the buy models to complete. Now, this part of what I said might make sense of why the market maker models will complete, but why am I telling you about the market maker models that don't complete? Well, I understand that not all of you guys are going to, have the same trading personality. Now, some of you guys might be, the counter trend trader, and the majority of you guys are going to be pro trend traders. So for you counter trend guys, this could be your model right here. Maybe you understand that price is going lower, but you know, you don't you don't necessarily trade the trend as well as everybody else. So if you're more of a contrarian, this could be your model right here. And then I just gave you the logic and the potential environment for when you can see this form. All right, so hopefully all that makes sense. But that's what I mean when I say all of this. So now that we've introduced the market maker model, let's move on to the next slide. All right, so stops to inefficiencies and market maker models. So in this, I want to kind of point your eyes towards something that, was kind of hidden in plain sight that you might have, missed if I didn't point it out. So we understand that in a bearish environment, price is going like so. So price is trading stops towards the inefficiencies, stops towards the inefficiencies, and stops towards the inefficiencies, and so on and so forth. Now, let's add in a advancement. So we understand that in a bearish environment, the market maker sell models will complete. Now, what is a completed market maker model? Well, think about it. Price has gone higher, and then it has come lower. What is this? This portion of price right here is a balanced price range, right? Balanced price range. So every single time that a market maker model completes, it's actually forming a balanced price range. So price has delivered buy side and it's delivered sell side within that area. So now let's add in our understanding of the market maker models that don't complete. So we understand that price is bearish. So these balanced price ranges shouldn't want to get taken out. So price, delivers lower on the sell side of the curve, and then it comes back higher. So let me make this a blue color. So price then comes up higher, but what's it coming back into? Yes, it is coming back into this inefficiency, but also it's coming back into this balanced price range. So we should see price, be resisted by this balanced price range and then come lower. So we understand that order flow is bearish, and we also understand that a completed market maker model gives us a balanced price range. So those two things should act as resistance to then send price, back down. So price goes higher and then it has an easier time coming lower. So that's that advancement that will help us understand why in a bearish environment, these market maker sell models won't tend to complete. And then same thing on the buy side of the curve. So let me make this a blue color again. All right, so price is trading stops back down into inefficiencies. So every time that a market maker model completes, it's creating a balanced price range. So price comes lower and then it goes higher. So this right here is a balanced price range. This pink portion of price right here is balanced. And we understand that we're in a bullish market environment. So price then goes higher and then it comes back not only to this inefficiency, but also towards this balanced price range, right? This BPR slash, this inefficiency right here. So that's why this market maker sell model shouldn't want to complete, is because it's encountering this balanced price range and this inefficiency in a bullish market environment. And since it's bullish, this BPR should send price higher. It should act as support to then send price higher. Now, I'm going to add in one more thing that we'll discuss in more detail towards the end of this lecture. But if you guys have, watched our previous videos, you'll understand that we say that price trades stops to inefficiencies when we're trending. And then when we trade or when we reverse, price should trade from stops to stops. So stops to stops. Now, using our newfound understanding, what did price just do? Well, price just took out this balanced price range right here, right? So price went up. Let's make that a blue color. So price went up and then it came down within this area. So this right here, this pink portion of price is a balanced price range, right? So it should have acted as resistance to send price lower, but instead it gets taken out. So that's why, this serves as an early indication that maybe we're reversing. And if you guys are familiar with what we say, we teach this as a interbank dealing range. So IBDR, or just dealing range as we call it. So price should then want to come lower, give us phase 3, and then go higher, right? So what's happening here? So why should price want to give us phase 3? Well, it took out this balanced price range, but in doing so, it also created a new balanced price range. So price comes lower, and then it goes higher within that same range. So this area right here is now balanced, right? It's balanced. So that's why we anticipate for phase 3 to form, because price should hit that balanced price range. And then since it's already balanced, it shouldn't want to work within there too much. And then it should want to deliver back to the upside to take out phase 2, right? So phase 1, phase 2, phase 3, and then 4 should want to take out 2. All right, so that's that logic behind what I told you guys in that last slide. And there's an application to this, which we'll talk about towards the end of this video. But for now, just take this understanding. And this is something that you might not have even thought about when you were looking at price. All right, so let's go ahead and move on to the next slide. All right, so let's talk about the anatomy of a market maker model. So the first thing is the original consolidation, and I call this the start of the delivery, right? So I don't necessarily classify this as a consolidation because not every single time is it going to be a consolidation. So that's why I label this as the start of the delivery. All right, and then we have the reaccumulation. That's the area where smart money gets into additional positions or hedges their positions on the buy side of the curve. And then the redistributions, that's the area where smart money gets into additional positions or hedges their positions on the sell side of the curve. Excuse me. And then the smart money reversal, that's the area where price changes its state of delivery. And we understand that this needs to take place at a PD array. And then we have that low risk sell or that low risk buy. And that's an earlier entry that is offered after the smart money reversal. All right, so right here you would have that low risk sell, and then right here you would have that low risk buy. All right, so within this example, this is that market maker buy model. So price starts its delivery here at that original consolidation. Price comes here, and then here is that here's that redistribution level right here in red, and then price comes lower, and then here is that smart money reversal. And then this right here is that reaccumulation, and then once price takes this level out, this right here is your terminus. All right, and then same thing on this example right here. I'm pointing towards this one right here. So here's that original consolidation, OC. Here's that reaccumulation level. Here's that smart money reversal, price changing its state of delivery. And then here is that redistribution, and then once we take this level out, that is our terminus. All right, so that's that anatomy of a market maker model. Now let's go on and move on to the next slide. All right, so here's that market maker sell model. So what is a market maker sell model and what happens within a market maker sell model? Well, during a market maker sell model, the algorithm will start the delivery from the original consolidation and will eventually drive into a key level or PD array, and then it will change its state of delivery at that smart money reversal. And then from this change in the state of delivery, we will see price run lower. And then in a bearish market environment, the retracements are just the buy side of the curve, and the expansions are the sell side of the curve. So what do I mean by this? So this is a market maker sell model. So this is what's happening. So we understand that a market maker sell model is when price goes higher to then come lower. So since we're in a bearish market environment, that retracement shouldn't want to take out this high. So that's why in a bearish market environment, the buy side of the curve is that retracement, and the sell side of the curve is that expansion. And we talked about why price shouldn't want to take out this level in that last slide where I talked about balanced price ranges. All right, so in this example right here, here's that original consolidation, and price is engineering liquidity on that buy side of the curve to then, meet that PD array and then come lower and, take out that liquidity. All right, so that's that market maker sell model. Now let's go on and move on to the next slide. All right, so here is an example of a market maker sell model. So what's happening here, and this is from EU from around December. So the late part of November and the early part of December. So what you can see right here is that price left this area right here, and then it expanded higher, and then it left those levels of fair value. If you don't know what levels of fair value are, go and watch our older videos, and you should be, up to speed on those. But basically, price is then creating this market maker sell model right here. So here's that original consolidation. Price is reaccumulating here, and then price goes higher over here, and then it changes its state of delivery, and then it comes lower, and then it takes out this original consolidation, and then it comes a little bit lower because the area that it's seeking is this level of fair value. But as you guys can see right here, original consolidation, we reaccumulate to go higher, price meets, what it was looking for, and then price then starts to come lower, and then it ultimately meets its objective right over here. All right, so that's that market maker sell model. Now let's go on and take a look at what a market maker buy model is. All right, so in a market maker buy model, the algorithm will start the delivery from the original consolidation and will eventually drive into a key level or PD array and change its state of delivery. And from this change in the state of delivery, we will see price run higher. And in bullish markets, the retracements are the sell side of the curve and the expansions are the buy side of the curve. So here's that bullish market environment. Let me make that a different color again. So here's that bullish market environment. And then we understand that price should be wanting to go higher. So here's that PD array that price is seeking. So price is going to retrace back inside the range, but the retracement is just the sell side of the curve. And then the expansion, or that real move to then go higher back in line with order flow, that is that buy side of the curve, right? So in a bullish market environment, the sell side of the curve is the retracement and the expansions are the buy side of the curve. So let's go ahead and make sense of what's happening over here. All right, so price starts its delivery from that original consolidation, and then price comes lower. Price is redistributing on its way down, and then price finally meets that array that it's looking for. So PD array, And then we understand that PD arrays have that potential to give us that change in the state of delivery. And then we see that price is then moving higher as a result of us hitting that PD array. And then here's those reaccumulation levels. And then price reaches its terminus right over there. All right, so now let's take a look at a real example of a market maker buy model. All right, so here is that example, and this is just a continued picture from what I showed you guys from the sell side of the curve, or sorry, from the market maker sell model. So as you guys can see, the PD array, or that level that it was looking for, was this level of fair value. And, so that's that breaker level right here. So it meets it, it comes back lower. And then as a result of us hitting that level, price shifts over from the sell side of the curve on its way down to then going on to the buy side of the curve over here. And since we were in a overall bullish environment, price took out this level right here. All right, so that's that market maker buy model. All right, so now let's go and move on to the next slide. All right, so how do we spot market maker models? Well, the first thing is, what is the higher time frame order flow? Are we bullish or are we bearish? All right, and then the second thing is, the higher time frame stops become the original consolidation, and the higher time frame inefficiencies or PD arrays are the areas of the smart money reversal. So this right here is the reason why I identified that original consolidation as the start of the delivery. All right, so that's why I labeled that as the start of that delivery. So let's say that we're in a bullish market environment. So price is trading stops to inefficiencies, and we understand that price should be wanting to go higher back in line with order flow. So this right here becomes that original consolidation. This area of higher time frame stops is your original consolidation. And we understand that this PD array, and in this case, this inefficiency, is where that smart money reversal should most likely want to occur. So this inefficiency slash PD array, whichever one it may be, it doesn't always have to be a inefficiency. It could be any one of those PD arrays. As we saw in that last example, it hit that fair value gap and that level of fair value. So price starts its delivery lower in this case from this high, right? So old highs, that's where buy stops are housed. So that's why I say that higher time frame stops become that original consolidation, and then price comes lower. It meets that PD array. And then after satisfying that PD array, price then moves higher. And then this level right here becomes your smart money reversal, which is just a change in the state of delivery. All right, so that's how you spot market maker models, and that's how you can, be able to better predict which side of the curve you're on and where the market maker models are most likely to form. All right, so with that being said, let's move on to the next slide. All right, so the next important thing to talk about is order flow. So order flow is a measure of whether we are bullish or bearish. And when we are bullish, we want to see bullish PD arrays and down closed candles supporting price. And we want to see bearish PD arrays and down closed candles being negated. All right, so let me underline a few key things. So down closed candles supporting price and up closed candles being negated. So that's during bullish order flow. And then when we are bearish, we want to see bearish PD arrays and up close candles supporting price. And we also want to see bullish PD arrays and down close candles being negated. So these two things that I have underlined in both green and red are what I call the two conditions of order flow. So when we're bullish, price is going to do something like this. right? So we come back down into that down close candle, and then we do something like this. All right, so these up close candles should want to get taken out, but these down close candles should want to be respected. Now, why is that? Right? So let's talk about the why, right? Because there's always a logic behind why we should, have this anticipation. And the reason for that is because these down close candles actually become balanced price ranges in a fractal sense, right? So what's happening as these down close candles are forming? Well, price is opening here, it's coming all the way down here, right? So it's actually going there and then it's coming lower, but the idea is that it's coming lower. And then as this up close candle is forming, price is then going higher, right? So this right here is a completed market maker model, right? So price should want to be supported by this level as we go higher, right? So those are the two conditions of order flow. And now let's take a look at that opposing order flow. So in bearish order flow, we have something like this, right? So we have an up close candle, down close candle, up close candle, and then we have a down close candle right here, right? And then the same thing. So why do we expect for these up close candles to serve as resistance on price? Well, think about it. Same thing that we talked about here, just inverse. So price is, ultimately trading higher since it's an up close candle. And then price is then trading lower, right? So this area, this blue shaded area of this up close candle, or this blue shaded area, which represents the delivery of this up close candle, and then, this part of this down close candle represents a balanced price range. Price has delivered both buy side and sell side through that area. So when price is coming back into it, this area right here should serve as some sort of resistance. So how do we know when order flow has changed? Well, both of these conditions of order flow, the down close candle supporting price and the up close candles being negated, need to change, when we're changing from bullish to bearish. And both these conditions of up close candles supporting price, or sorry, resisting price, and down close candles being negated need to change, right? So you can't say that we have a change in order flow just because price started doing something like this, right? So now these up close candles are being negated. So just because those up close candles are being negated doesn't mean that we have a change in order flow. We need to then see these down close candles start to support price, right? So when we have something like this, then we can say that we have a change in order flow. Because think about it, in a fractal sense, price is delivering lower and then delivering higher. So this right here is a completed market maker model or a balanced price range. So when price comes back lower, we want to see these balanced price ranges, act as support on price. And then when, these balanced price ranges start acting as support, and then we start trading higher as a result of them, that's when we can say that, order flow has changed over. So that's why we require both of those conditions of order flow to change, right? And then just use the inverse logic for this example right here. All right, so that's that little bit on order flow. Now let's talk about this point right here. So there's only ever the buy side or the sell side of the curve. And that's because the algorithm is running on buy programs and sell programs. So you're either seeing price going higher, price coming lower, or price moving sideways, right? So, and when it's moving sideways, it's typically just reaccumulating or, in a area of redistribution. But, there's only ever that buy side or that sell side of the curve, right? So there's only ever bullish order flow or bearish order flow. And then when we have bullish order flow, we're on the buy side of the curve. And when we have bearish order flow, we're on the sell side of the curve. Right? So that's why I say that order flow is a means by which we can tell which side of the market maker model curve we are on. All right. So with that being said, let's go back to one of the previous slides. So let's take a look at this. So right here, buy side of the curve, sell side of the curve, right? So there's only ever the buy side or the sell side of the curve. And even when we're consolidating within one of those two curves, right? Because it's either a reaccumulation or a redistribution, essentially, right? So buy side of the curve, sell side of the curve, and then buy side of the curve, and then sell side of the curve, right? So either either bullish order flow or bearish order flow, right? That's literally all you're seeing because the algorithm is always running on buy and sell programs. All right, so I just wanted to go back to that example to kind of show you guys what I meant when I said that. So let's go on and move on to the next slide. All right, so here's one more advancement, and I've kind of alluded to some of the stuff that we're going to talk about in this slide, in the earlier slides, but now let's really put the pieces together here. So how do we know that we have switched sides of the curve? Well, understanding when the two conditions of order flow have changed as a response to hitting a higher time frame key level is one way of gauging if we have switched, if we have switched over to the other side of the curve or not. So let's say that we have bullish order flow, and then we meet this level. Actually, let's make that a different color. So we have bullish order flow, we meet this higher time frame key level, and then as a response to that, so we understand that we were on the buy side of the curve. So up close candles are being negated. Down close candles should be supporting price. And then after we hit this higher time frame key level, we then start to see the opposite. So instead of up close candles being negated, these down close candles start to be negated. And then these up close candles start to serve as resistance on price, right? So that's one indication that we've switched over to the other side of the curve. And then the other tool that you can use is, these graded price swings, which I've already talked about in an earlier video. So you guys can go watch that if you guys haven't seen that already. And then now the more important parts are these two right here. So on the sell side of the curve, we want to see the reaccumulation levels get taken out from the left side of the curve. And on the buy side of the curve, we want to see the redistribution levels get taken out from the left side of the curve. So I have some chart examples to try and illustrate this. But this right here, these 2 points right here, should clear up a lot of things for you guys and connect a lot of dots in terms of understanding the market maker models. All right, so let's go ahead and go on to those chart examples. All right, so here is that same example from earlier, but now with a bit more context. So we understood that price was reaccumulating within this area, but how do we know that we've changed over to the sell side of the curve? Well, after we've taken out this level, right? So we can see that that order flow has changed over, right? So those down close candles are being negated. These up close candles are starting to support price, but we want a bit more information. We want to have that additional confluence. Well, here it is right here. So on the buy side of the curve, so let's ignore all of this. Let's say that none of this happened. On the buy side of the curve, we took out that buy side liquidity, we moved higher. But now on the sell side of the curve, so buy side of the curve, we took out that liquidity. And then on the sell side of the curve, we then come lower and then take out that level. What does that look like? Well, I talked about it in one of the earlier slides, but this right here, it takes out that reaccumulation level. It takes out that reaccumulation level, but why is that significant? Well, it creates a dealing range, right? So we have that buy side sweep, that sell side sweep. Price then comes up. So this is phase one, phase two, phase three. and then price comes lower. But there's one more thing. So let's look at this right here. This right here is a completed market maker sell model. Price goes higher and then it comes lower. So right here, what is this? This right here is a balanced price range, right? So once price comes up here, we anticipate for this area, this entire range, to serve as resistance on price and then to send it lower. That's why these reaccumulations and redistribution levels, when they get taken out, those are good signs that we've changed over to the opposing side of the curve, right? And then here's another bit of information. Think about how many times we've already delivered within this area. 1, 2, 3, and then on this side, 4 times already, right? So price doesn't need to redeliver past this area again. So you can see that when price goes up into that level again, it just drops, very rapidly, right? So that's that other confluence or that other way of looking at this, that you can apply in your own trading when, trading the market maker models, right? So let's move on to the next example. All right, so this is on that buy side of the curve in that bullish example during that market maker buy model. So price hits that level of fair value and that breaker slash fair value gap area. So we see price going higher. We see that order flow start to change over, but we want to be a bit more certain. Well, we wait for price to, want to take out these old areas of redistribution. So price does a sell side sweep here. And then as we're going on to the buy side of the curve, it ends up doing a buy side sweep. So what does that make this? This makes this a dealing range. Now, I have to admit that this isn't an A plus dealing range, but it does, fit that description. If I were to grade this dealing range, it would be a C setup, but that's okay because it still plays out and it fits that logic. So price is delivering phase 1 here, 2, 3, and then notice how phase 3 doesn't ever get taken out over here. So price then eventually takes out this level right here. And seeing this dealing range should have been that additional confluence for us to, potentially see this as that buy side of the curve. All right, so hopefully that makes sense for you guys. Now let's take a look at a few more examples and then we'll end the video there for today. All right, so here is an example from my back testing that I found that I wanted to share with you guys. So here's this higher time frame level. Price is going higher. And then this area right here is that old reaccumulation level. And then you can see that this is a 15-minute chart. Oops, let me wait for this to go. Just give me 1 second. So here's that 15-minute chart. And then on the 15-minute, we sweep buy side on the buy side of the curve. And then on the sell side of the curve, we take out sell side. But that's not it. Let's look at this as a balanced price range. Price has delivered 1 time, 2 times, 3 times, 4 times to that area already. So when price comes back up in here, we see that rapid decline in price because price has shifted over to the sell side of the curve. Price gives us that dealing range because, this old reaccumulation level is negated, which is a BPR. So that's why I have that highlighted as so, right? Because that's a BPR. And then price comes lower. It comes back within this inefficiency. And then that serves as our catalyst to then take price lower. And then maybe you could have seen these equal lows as that original consolidation. Right, so let's go on to the next example. And I believe that the next example is the last example. All right, so this is something that me and the group saw today. So today is January 11th, and this is something that presented itself to us today. So right here, during the time of this, we were wanting to see lower prices on EU. This was that 15-minute fair value gap. And then notice how price is delivering up to that fair value gap. So here's that original consolidation. Here's that reaccumulation level, reaccumulation level. We hit that PD array. And then what do we start doing? Well, price takes out those levels. So on the buy side of the curve, these down close candles were supposed to, serve as resistance or sorry, support on price. And then we see that these down close candles start to get negated. So that's one sign that order flow is changing. And then the main thing for us was to see this right here. Right, so let's actually make that a different color. So we saw this buy side sweep, we saw the sell side sweep. On the buy side of the curve, we swept buy side liquidity. And then now all of a sudden, as a response to hitting this higher time frame key level, we end up sweeping sell side. So that gives us that dealing range. And then here's a potential entry that you could have taken. So you understand that we were trying to see lower prices initially. And then here's that dealing range. And then price comes right up into that level of fair value. Even though this is on that 1 minute time frame, look at that precision right there. Price hits that level, and then we see that drop coming from that level of fair value. Why do we see such a explosive response from there? Well, think about it. Look at how many times we've already delivered within this level. 1, 2, 3, 4, 5, 6 times within that level. Does price really need to deliver within this area again for this price leg? I don't think so. Because if we're truly intentional about going lower, we should see, some measure of or a lot of bearishness come in from here because price shouldn't want to go higher, right? So price hits that level and then we see that decline into there. And then, we took profits around that low right there. All right, so hopefully everything that I talked about today opened your guys' eyes to balance price ranges and some additional insights into what you might have been missing when looking at market maker models and just price action in general. So I hope that you guys found this video insightful, and I'll talk to you guys in the next video. Cheers.